Readings on inflation are likely to rise somewhat further before moderating.
You'll be looking at significantly higher inflation than the Fed expects.
There will be more bumps in the road.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 13th of May. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Musk's Bitcoin U-turn. The Tesla chief executive says his company will no longer accept the digital currency as payment, citing concerns over its environmental impact. Well, cryptocurrencies slip. Inflation shock. U.S. core CPI hits its highest level in almost 40 years, sending the S&P 500 to its third straight down day. And life is short. Bill Gross's successor at Janus Henderson quits at 44. How can finance hold on to talent in an age of reevaluation? Well, good morning. A lot going on today. There's one word on traders' minds this morning. That's, of course, inflation. This higher than expected CPI print for April sent U.S. stocks lower for the third day straight. The core figure rose the most in almost 40 years. Now, here's what our guests had to say in the aftermath of the report.
Under my baseline, I expect inflation to return to, or perhaps run somewhat above, our 2% longer run goal in 2022 and 2023.
This is a time when I would expect there to be a fair amount of volatility in inflation.
We need to expect some surprises because the economy closed down in a very synchronized manner, but it's reopening in stages.
There will be more bumps in the road.
The market's definitely challenging the Fed's presumption that inflation is actually transient.
We're at a bigger turning point than the Fed's going to be describing at this moment.
The Fed and others have rested a lot on inflation expectations being anchored. This is the type of thing that's going to start to move those inflation expectations.
Well, let's get into the markets now with our Danny Berger. Danny, what are you seeing today? And I guess the million-dollar question, or the only question that's worth asking, is really whether this one print of inflation changes or upends what the Fed's intentions are.
Right. Well, the market is almost treating like it will, Francine. And look, when we came in very early this morning, it actually been a very different picture than this. We had stocks, at least U.S. futures, coming back a bit. We had yields falling again. That's not the case now. As we've gotten closer to the U.S. Open, not only did the MSCI Asia Pacific Index fall 10% from its February peak, we're now seeing S&P futures and NASDAQ futures getting close to a 0.5% drop. Of course, it's nothing like the 2% plus we saw fall in the NASDAQ, but we're looking at yields about 0.5 basis point. Again, not huge moves, but they're certainly turning into that risk-off direction. Now, in terms of whether this is going to stick around or not, the big question, how the markets are going to treat it, it is really interesting to not just look at CPI on the aggregate level, but to look at some of the individual readings, too. For example, one of the big components this time around was used vehicles and renting cars. Those prices surged because we have dealers, rental car dealers, rather, who are now buying back used cars because there's demand there again, and the chip shortage causing issues in new cars. So when you look at things like that auto price uptick, hotels, people getting back to normal and traveling, they accounted for the CPI way more than they usually do. It's in the white here, their percentage contribution to the core. It's usually just fractional, and here it surged about 10% according to this bespoke chart. So I think this just goes to show that a lot of these forces that are having this huge impact on this latest reading of CPI, they absolutely could be transitory. Of course, things like wage increases and restaurant price increases are ones to watch for.
Yeah, I mean, I guess the concern is that also we don't believe maybe our forecasters like we used to, because we were also so off in terms of the jobs report last week. Bitcoin, I mean, this is an incredible story. Elon Musk now saying that Tesla will no longer take payments in Bitcoin because it's not green enough.
Yeah, and I think that this was a little bit, surprising and maybe confusing to a lot of market participants, and that's part of the reason why we've seen Bitcoin fall so dramatically at 1.15% yesterday, because as Nick Carter from Castle Island Ventures put it, surely he would have done his due diligence prior to accepting Bitcoin. Very odd and confusing to see such a quick reversal. Now, we don't know why he made this U-turn. It could be, he's getting pressure on that ESG front, which is why he mentioned the environmental costs. Maybe he's worried about regulation as well. But this is certainly something that's troubling for Bitcoin, because Elon Musk adding it to the balance sheet, accepting payments was a really clear catalyst for Bitcoin. So we could see other coins pick up that relative value trade, outperform Bitcoin, Francine.
Danny, thanks so much. Danny Berger there with the very latest on the markets. Now, we're delighted now to be joined by Davide Serra. He's Algebris Chief Executive Officer. He is very involved in the markets and, of course, does a lot when it comes to banks. So, Davide, we'll get on to the banks in just a second. But first of all, I guess with all of this question, which is what assets will suffer the most because of inflation expectations, is it transitory? What does it mean for all of your investments?
Well, I would say, listen, as we're mainly a financial investment group, we love higher inflation. And we've been paying, in a way, financial repression and negative rates for many years. So we can't wait to get the world back on a normal footing with positive real rates and inflation around stable 2% globally, and hence rates that will be back to in positive territory. So we're very excited, and I think the next 2-3 years are going to be the best years that we'll have ahead.
But this is supported by what kind of monetary policy? Or is it earnings? Is it specific companies that you're looking at?
Well, it's both. You see, in a way, if you think about it, over the last 20 years, this has been a massive value of transfer between those that had cash, so financials, vis-a-vis those that were massively indebted or were selling dream in the future for the next 30 years. So basically what's going to happen with inflation picking up is a tech stock that makes no earnings and are valued on bubble dreams are going to collapse, because suddenly keeping cash before used to be tax. So you're losing money by keeping it idle. While now, I think over the next 12 to 18 months, central bank will be forced to go back to neutral stance and positively, hike rates over the next 1 to 2 years. It's inevitable. People are ignoring the fact that in the fourth quarter in the United States, more dollars were printed than in the 5 recessions before combined. So you had 2000, the global financial crisis of Lehman Brothers, you had the 2001 dot-com bubble, you had the 94 crash, you had the 88 crash. Well, if you take 5 recessions combined over the last 40 years, more money had been printed in the fourth quarter alone of 2020. So how this cannot be inflationary, God knows, who does forecast. So we had a very clear view. So it being short duration, long equity in financials, and basically we're sailed up for a reflationary trade that I think is going to happen and last in the next 2-3 years. And most market participants are going to say no for the simple reason, because they've been benefiting for 40 years out of this central bank action. So now, I'm a Catholic person, and we used to believe, God is the response to anything. Now there are market participants that think the central banks can do anything. Well, that's not true.
But what does that mean, Davide? That 2-3 years we have some kind of normalization, but do you think there'll be a big market rout in the next couple of months? Is there a mistake by the Fed and others saying that actually this is transitory?
Well, for example, take Europe. There are people that believe the Bund 10 years will always be negative. It's like a religion now. And on our numbers, it's mad to have a Bund negative at 10 year. We think inflation is going to reach 3% in Germany. It's going to be stable higher than 2% in the coming years. And as a result, we think the Bund, should be positive, 50, 60, 70 basis points, the 10-year Bund. And, there are majority of market participants that think this is mad. We think it's going to happen. It's going to take 12 to 18 months. Central banks have always been slowed. They watch the movie and then they react. They did this in the global financial crisis. They waited the meltdown, then they acted. This time with COVID, they were faster. Now we're seeing the first data of inflation. Now it's 10 years they tried to reflate, almost 20, then not being able. Hence, they're not going to immediately put the fire down. So the fire is going to, take up, a bit like happened with COVID. No one is doing anything for the first 3-6 months because they say, well, that's not sure. Let's see, let's monitor. And then as soon as inflation expectations are going to rise, that's it. It's going to happen. And so that's why we think it's time to go back in real earnings, real value, low multiple, company that make, widgets. Think about the price of timber exploding because new homes construction. So I think more real economy, less digital and tech. That, to me, is what investors should be doing for the next 2 years.
Davide, thanks so much. Davide Serra there of Algebris stays with us. He certainly didn't mince his words on Federal Reserve and general central banks, so we'll see what he says about the actual banking business as well. Now, coming up on today's program, Elon Musk's Bitcoin U-turn and the successor to Bill Gross retires at age 44. But up next, we'll discuss the European banking environment as well as the outlook for Italy with Davide Serra. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Europe's banks are said to be lobbying the ECB to extend capital relief granted during the pandemic. Currently, lenders are allowed to exclude deposits held at central banks when calculating their leverage ratio. But that exemption is due to expire in late June. Now, the pressure on the central bank comes at the same time as pressure on the bloc's government. The Italian Premier Mario Draghi told Italian Parliament this week that the EU must ease fiscal rules in order to allow more country-specific investments. Well, let's get back to Davide Serra of Algebris. He's still with us. Prior to founding Algebris in 2006, he also headed the European Banks research team at Morgan Stanley and was consistently rated among Europe's top banks analysts for a decade prior to that. A fact that a lot of people often forget, Davide, so we just thought that we'd bring it to the attention of people right now. Davide, when you look, first of all, about the banking sector, do you have a favorite European bank? Are we finally going to get the consolidation that you and I have been talking about for quite some time?
Listen, I think from an equity perspective, we think that the two companies that right now, from a cyclical perspective, valuation, market positioning, have the highest upside are UniCredit and Barclays. For very different reason, different mix, and we think both are in a way the cheapest from an equity perspective. From a credit perspective, we think that all the global SIFI are very attractive around the world, and in particular in Europe. And hence, we remain favorably positioned. And the key reason is financial credit and financial equity benefits if there is inflation. So sometimes you need to be very simple. Inflation is super positive for financial assets, in particularly banks, even more than insurance. And as a result, this is the reason why we remain, positive on what we own.
If you were to change, I mean, are you actually buying any more of some of these banks? You look at, changes at the top. I'm thinking of UniCredit. I'm thinking also at some of the Swiss banks, some of them also in a spot of trouble. What will define success? Is it strategy or is it execution, almost no matter what strategy is?
I think there are three reasons to be positive for the next couple of years. The first one, I think, what's going to happen is the overall rates outlook is going to change. So basically, these companies lost revenue because of central bank action, and they're just going to get it back where it has always been. Secondly, I do believe the capital return is happening because lots of them have built capital. The buffer now are as high as they've ever been. And so there's going to be more capital relief in Europe, exactly what we saw in the States. And third, I think, it's all about implementation and execution. In banking, there is not much strategy. It's very simple what you got to do. And it's all about execution and relentless execution. So less consultants, less lawyers, more old-fashioned bankers.
So old-fashioned bankers that will consolidate or not? I mean, there are questions about, whether Europe is just still too banked and can even keep up with some of the big U.S. giants.
Yeah. No, listen, I think you will see cross-border consolidation in Europe where you'll have the same judges. So the day you have a legal cause, and in Germany, in France, and in Italy, you can go to one court and settle in 3 states, then you'll have cross-border consolidation. If not, it's never going to happen.
David, we have this news, that Schroders studied a possible M&G deal that would have created, I think, a fund manager or asset manager worth $1 trillion. Are we going to see consolidation in asset managers? Already they've been through a wave. Is there a second wave coming?
Exactly. So asset management, it's one of the few industry in financials, together with payments, where actually you do have cross-border synergies, for the simple reason that once you have a product, you can actually sell it pretty much around the world with very little legal cost locally, very different from traditional banking. So I do believe there's going to be more cross-border consolidation in asset management, whether active or passive. And I think, for example, take Schroeder, which is one of the oldest and best managed business over centuries. I think, for example, they have plenty of cash, and they could easily decide to buy what has been recently an underperforming assets in M&G, mainly due to its overexposure in retail and some bad performance over the last 3-5 years. So I'm sure there will be more consolidation. If that was to happen, for example, I think would be a very positive move, because we do need to make more European champion. For example, Amundi has clearly emerged as the European winner in asset management. Yeah. And you already have Allianz with PIMCO and Allianz Global Investor. And I think all of them are thinking how to scale up in the business, which does have critical mass and economy of scale.
Davide, I also just want to get your thoughts on a story that has really, captured the imagination of many, which is the successor to Bill Gross actually retiring age 44 because he also wants to spend a little bit more time with the kids. In a year of pandemic, or the year after the year of pandemic, do you think a lot of people will want to leave these finance jobs? Is it going to be much more difficult for chief executives to hold on to talent?
Well, I have a different take on it. So first of all, if you've been a bond investor over the last 40 years, the average global bond yield was about 6%. And for 40 years, it went up being almost zero. So basically, you only made money. It was almost impossible to lose money. I think now with rates at zero, if not negative, and inflation going up, being a bond or fixed income investor is going to be a hell of a job to make money, because mathematically it's almost impossible. So I think for traditional bond-only investor to make money going forward is going to be pretty much impossible. And hence, I think if you are in an asset class that for 40 years you could only win, and now for the next 10 years probably you can only lose, I think eventually you say, hey, I had enough, I made enough money, and probably pandemic made you rethink some of the decision. For example, I took a decision, I remember, 15 years ago to leave Morgan Stanley, which is an excellent firm, and the research department is first class, globally has always been, simply because I thought I wanted to have more control on my own time. Not that I did work less, but being an entrepreneur allows more flexibility. You end up working longer hours and harder, but at least you have the flexibility of when and where. I think in some of these large institutions, actually that's the number one problem. You don't have that time flexibility, which then, collapses your quality of life as a parent, basically.
Davide, thank you so much, as always. Always enjoy speaking to you. Davide Serra, there, Algebris Chief Executive Officer. Now, coming up, the biggest U.S. gasoline pipeline restarts after a cyber attack, but it's unclear how long it will take for supplies to get back to normal. We get the latest next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the biggest gasoline pipeline in the U.S. is returning to service. Almost a week after a cyber attack that saw gas stations run dry, Colonial Pipeline Company says it began to resume shipments yesterday at around 5 p.m. Eastern Time. Unclear, though, how long it will take for supplies to come back to normal. The U.S. Energy Secretary said it could take days to fully restore supplies after the start. Let's get straight to Will Kennedy, Bloomberg's executive editor for energy and commodities. Will, great to have you on the program. So how long do you think it'll go back to normal in terms of finding gas at the pumps?
It's going to take a little while. The pipeline is flowing again, but it's being done on a mechanical basis. The whole Colonial system, including all their IT systems, isn't up to normal, so they're having to rely on paper and telephones to get the pipeline moving again. And I think that means that it's going to be slow. And then, of course, there's the problem of getting the fuel from the pipeline stations into the gas stations, which takes a good supply of trucks and takes time. So that will start to happen today, but it's going to take time before all those gas stations which have run out do get more fuel. And, of course, in some states like North Carolina and Georgia, we've seen up to more than 50% of gas stations emptied. So there's a lot of catching up to do. So this is good news. It probably means the panic buying will slow, but I think it's going to take at least a few days before this thing totally unwinds.
Thank you so much. Will Kennedy there, Bloomberg's executive editor for energy and commodities. Now, price inflation in the world of fashion is something the industry has not seen in a generation or more. So how will the prospect of higher prices affect the way we dress? Up next, we speak to Jamie Gill. He's the chief executive of British fashion brand Roxanda. He also sits on the BFC's executive board. Musk's Bitcoin U-turn. The Tesla chief executive says his company will no longer accept the digital currency as payment, citing concerns over its environmental impact. Cryptocurrencies slip. Inflation shock. U.S. core CPI hits its highest level in almost 40 years, sending the S&P 500 to its third straight down day. And life is short. Bill Gross' successor at Janus Henderson quits at 44. How can finance hold on to talent in an age of reevaluation? Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 13th of May. I'm Francine Lacqua in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The diplomatic push to end the clashes between Israel and Gaza is intensifying. President Joe Biden spoke with Israeli Prime Minister Benjamin Netanyahu yesterday. He defended Israel's right to respond to the rocket attacks and said he believes the violence is resolving itself. So far, over 60 are reported to have been killed in Gaza and at least 6 in Israel. Now, U.S. regulators have cleared the Pfizer and BioNTech vaccine for use in children ages 12 to 15. It opens up an important new phase in the U.S. vaccination effort. In the EU, the bloc is asking its member states to ban all non-essential travel to and from India. The so-called emergency brake is to limit the spread of new variants. The judge overseeing the high-stakes trial between Apple and Epic Games is hinting at a compromise. The idea is to let app developers inform their users that the iPhone maker's virtual store is not their only shopping option. It could quell at least some of the concerns of the Fortnite maker, Epic. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Now let's get straight to the markets with our Danny Berger. Danny, carnage in the European session after the CPI yesterday in the U.S.
Yeah, and look, it's not just Europe, it's Asia as well. The MSCI Asia Pacific Index down 10% from its February high. And it is really interesting to see that from that CPI print, we first get this, gut punch, reflationary trade sort of reaction where you have tech, the highly valued things doing the worst. But what it's morphed into as we get further into this European session is just general risk off. Perhaps it's just because regardless of whether this inflation is transitory or not, financial conditions are starting to tighten with that temporary reading. So we're down 1.7%. Less than 20 stocks in the stock 600 are moving upwards. We do have Switzerland, a lot of the Nordics closed, the Baltics closed. So that's less stocks to play with here, but still we're not seeing a lot of positive moves. So NASDAQ futures still lower, about in line with what the S&P 500 is doing. 10-year yield, this has been going back and forth, basically flat so far today, and we are having a slight bid for the dollar. But something that's surely not going to help the U.S. session as well is Elon Musk talking about no longer accepting payments in Bitcoin. And pre-market, if you want to look in the U.S. and see what stocks are doing the worst, it's going to be all of your Bitcoin, all of your crypto-related stocks, whether it's Marathon Digital or you have Coinbase, Riot Blockchain as well, falling as much as 13.5%. Now, when it comes to Europe, again, it's that general risk off we were talking about, but there are some idiosyncrasies idiosyncratic stories in there. A lot of it has to do with earnings. Burberry, disappointing earnings, margin pressure there. Telefonica, better earnings. But in this macro picture, in this more risk-off market where we have commodities doing worse, we are seeing a lot of the materials sector leading losses here. So Rio Tinto down more than 4.5%, Francine.
Danny, thank you so much. Danny Berger there with an extensive look at some of the markets that we need to keep an eye on. Now, U.S. consumer prices rose 4.2% in April over its level a year ago. This has caught many economists by surprise, and of course, it's fueling concerns that the world's largest economy is overheating. The fastest rise in prices since 2008 comes at a time of fiscal support, supply bottlenecks, and increased spending amongst consumers. Now, price inflation in the world of fashion is something that the industry has not seen in a generation. Now, increasingly sophisticated supply chains made producing and shipping clothes more efficient, but how will the fashion industry fare in a world where costs are increasing and consumer habits changing? Well, joining us now to talk about the future of high fashion retail is Jamie Gill. Jamie is currently the chief executive of the British designer fashion brand Roksanda. Roksanda's clothes have been worn by Michelle Obama and the Duchess of Cambridge. And Jamie's main tasks there has been to restructure the business, to scale up the brand in late 2020. He also joined the executive board of the British Fashion Council, where he hopes to champion British brands abroad. So Jamie, thank you so much for coming back on Bloomberg Surveillance. We're in a pretty difficult year. The pandemic has made it difficult for buyers to come here and see the collections. A lot of the collections have had to be virtual. There's more demand for sustainability. And of course, in all of this, there's a pandemic, which means that people are often in sweatpants and or jogging bottoms. So what's the biggest challenge for the future of fashion right now?
Hi, Francine. No, thanks for having me on again. I think the biggest challenge right now is planning for recovery as well. Ultimately, I think when the first lockdown happened back in March 2020, I think we thought it was going to only last for 6 months, and come October we would be returning back to normal, which just sounds ludicrous now. And I think now, it's definitely going to run through into the end of 2022 before we can kind of start picking things up and getting back to what normal used to kind of look like. And I think in doing that, we've really got to think about resource. I think the industry's had to let a lot of staff go. We have the critical path is picking back up, but we really need to think about how we're ultimately going to do that, in the short term.
So, Jamie, first of all, are we going to shop differently? So, the UK is reopening. Will people go back into the store, or are most of your onlines, and in general, actually, some of the fashion brands that you represent, is it critical mass of sales online?
I think yes. I think ultimately we've seen a really, really strong trade on e-commerce, over this last 12 months. I think it's been the only kind of avenue and outlet for customers to buy from ultimately, and therefore has performed really, really well. I think and we, are big believers that retail has a big place. I think hopefully, there's been some fatigue from online, and that there's, demand to kind of get back into physical retail stores and see not just edit that is available online, but that experience the whole collection and have that shopping brand experience that, customers used to have. And I think it needs to adapt now for the future. I think it needs to look differently. I think technology will continue to play a bigger part in how we shop and those kind of consumer profiles that we can build, and knowing what songs our customers like, and be able to have WhatsApp on your changing room. I think all of those fun pieces are coming into play now. We're kind of seeing that, and I think retail is offered is an environment to have fun with as well. They are social, and I think that's a piece that consumers have missed, and hopefully I'm hoping are itching to kind of get back to. We're feeling it now, with the restrictions easing recently with retail. I think we've seen an initial uplift immediately, but obviously when tourism can resume, that will be the big ticker.
Jamie, the way we dress has also changed. I mean, maybe not if you're a TV presenter, but in general, have people, as people have been working from home, do tastes change? So do you have a lot of, high fashion brands, Roxanda and others? I can think of at least 10 of them, Erdem, some of the others in the UK. Do they go more towards a kind of more laid back way to style things because that's what will sell, or will people go back to evening gowns quite quickly?
Well, it's been really interesting, and I think over this last year we had to react as a brand, and I've seen all of our kind of the London brands looking at this, and globally, and big fashion houses offering categories that we didn't offer before because of the pandemic, and exactly what you're saying, Francine, the shift. And I think there has been a big uptake this last year of relaxed pieces, knitwear, joggers, transitional pieces, something that you can wear at home, something that you can wear in front of Zoom, and then be out to an office, to a meeting if they were happening, or to kind of pick up things, or that kind of movement that we've had to kind of deal with over this last year. So I think that has forced brands to kind of look at their category offering and introduce that. I think there will be a place for them to stay. I think brands will have. I've seen that offering a wider kind of mix to the market will retain. But I hope, and we've seen it even over 2020. I think those customers and those clients now who are confident in their decisions that these events are happening for them and kind of can back that decision, are buying, special pieces, are buying gowns, are buying dresses, are planning for events. We're hoping that the worst for some of for the UK, for instance, is behind us now in terms of restrictions, and that they can event for, and with that, we've missed out on it, as we all have for 15 months now. So to be able to celebrate, we're really hoping that there'll be a surge.
Yeah, we're all about transitional pieces on Bloomberg. When you look, Jamie, at some of the concerns about Brexit and the fact that certain things get shipped and then you have to pay tax on it, is it something that the British Fashion Council, and you've been looking at Roxanda, have you seen a dip in sales because of some of these customs arrangements?
I think we haven't seen a dip in sales. No, I don't. I think that's. I think everybody, we didn't know how to plan for this. And I remember thinking back in just over the Christmas break that we had last year, we were just so grateful to have zero tariffs. I think that was the relief that we'd been planning for. Oh my gosh, we're going to have to have tariffs on our margins. So I don't think there was no budget changes from your retailers to brands. I think they kind of stayed the same, and everyone was confident that we could get through it. I think the reality of it is, everybody, as is unprepared. We were unprepared. Smaller brands are unprepared. It's given rise to so much human error, so much learning, so much labeling, so much sourcing for, the origination of a product and labeling that as such. And, when that's coming through customs, there's been unnecessary challenge, I feel, as well, which with quite a skeptical eye on all of this to make sure everything is up to standard and everyone's adhering to this new red tape. And in doing that, we're into May now, we're soon going to be into June, kind of half of the year moving, and we're really experiencing those delays. All of our logistics suppliers are backlogged, for a better word. It is taking a considerable amount of time. And, we came over the first hurdle in January this year with the kind of spring-summer collections delivering, and there was a delay for sure. And I kind of hoped, okay, there was learnings taken away from this now, and we'll be able to implement that. Our factories will be better to prepare garments for shipping and from that coding and everything that is needed. However, we're now on to the next season, which would be, pre-fall now of the autumn-winter season, which is shipping, and we're still kind of experiencing those delays. And I think less so on the factory's part, but definitely, this backlog that's sitting there with, with DHL, with FedEx, and getting through. We need to now buffer in a good couple of extra weeks than we have been doing for next seasons.
Jamie, thank you so much. Jamie Gill there, Roxanda, Chief Executive Officer. Now, coming up, Elon Musk says he's suspending purchases with Bitcoin over its use of polluting fossil fuels. The U-turn sends a crypto to come tumbling. We'll bring you the latest next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Bitcoin's massive carbon footprint has come back to bite it. Tesla's chief executive, Elon Musk, has made a massive U-turn on the digital currency, sending shockwaves through the crypto market. In a tweet, he said the electric car maker is suspending purchases using Bitcoin, citing concerns about the rapidly increasing use of fossil fuels for mining. Well, joining us now is Eddie van der Walt, who writes for our Markets Life blog. He's also my personal crypto expert because he's the person I go to for any kind of crypto-related questions I ever have. Eddie, I mean, this is wild because actually we always knew that they were, that they were not green friendly, that these were not climate friendly cryptocurrencies. So why the U-turn?
Right, exactly. I mean, this is I feel like this was a little bit of an own goal for Elon Musk, right? Elon Musk is, he's famously, he's a celebrity engineer if there ever was one. So you would assume that going into all of this, he knew that this was, he knows the Bitcoin backstory. He knows how it's created. So somebody would have thought that, he knew that this was a fairly dirty technology all along. So I don't see what has changed on that front. And on the other side, I think it's an own goal because nobody associated Elon Musk with Bitcoin in the past. Then suddenly he gets on the Bitcoin bandwagon, and all of the crypto fans who wanted to, they all wanted to own Lambos suddenly said, well, we want to own Teslas. And now that same community, some of them who've grown very rich, will suddenly say, well, if that's what he says about Bitcoin, then I don't want anything to do with Tesla. So I feel like this is a little bit of an own goal for Elon Musk.
Okay, what was interesting, Ed, if you listen to, or if you actually and I know you've picked up on this, is basically he kind of opened the door for possible green crypto being something that he's interested in the past. Is there one? Is anyone working on it?
Yeah, look, Bitcoin, no, cryptocurrencies in general, the blockchain is a little bit inefficient by its nature, right? It is cheaper. So if we talk about distributed ledgers, it's cheaper to have a centralized ledger because then there's only one copy of it. So by definition, it's going to be higher in energy consumption. But that said, in that spectrum, Bitcoin is definitely one of the ones that uses more energy, and better technologies are coming along. But I guess he's opening the door to always accepting something like Ethereum, so that he at least doesn't do a U-turn twice on this issue. But there definitely are cleaner technologies.
I mean, is there any way of making these technologies a little bit greener? Does it depend on where they're actually mined?
It depends on where they mine. It depends on it depends on how the blockchain is structured too. So, for instance, in Dogecoin or in Ethereum or in any of the other cryptocurrencies, the supply schedule, if it's not as tight as in Bitcoin and is not as hard to mine, then you can scale it back, and it can be cheaper, but it's never going to be as in the nature of having a distributed network. Is always going to be less efficient than a concentrated network. I'm sure I'm going to get angry emails about saying that from crypto fans afterwards. But
I mean, we get a lot. I get a lot of angry emails, so that's all right, Eddie. It does seem like such a passion. Actually, when you look at all asset classes and all investments, right, crypto brings emotions like almost nothing else does.
Oh, absolutely. There's definitely a but I think that's common to new technologies. I think in the early days of the dot-com bubble, it was the same. People were really passionate, really excited, and as they should be. I think there are exciting things happening in this space, and I think technologies like Ethereum are doing things that we could never do before. Right? Selling non-fungible tokens, people laugh at them, but we are selling digital assets and transferring ownership in a way that we have never done before, and the proof of concept is there, and these things are going to be very exciting, and over time it will get cleaner. So I think there's still a lot to be excited about in the crypto space.
Eddie, thank you so much. I really enjoy our crypto updates with Eddie van der Walt there from MLive. Now, Bill Gross's successor quits his job, aged 44, to spend time with his kids. The man who took over from the Bond King says the pandemic has caused everybody to reevaluate. Are elite jobs worth their time and money? Well, we discuss that shortly with Bloomberg Opinion's Elisa Martinuzzi. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now, it's all about inflation. This is definitely the driver overall on the markets, and we saw an acceleration of concern that print we had yesterday, which really took everyone by surprise, means that the economy could be overheating. What's also interesting is that it's the second time that actually the focus is on the fact that forecasts have just not been up to scratch. And you can see oil retreating, global stocks falling to a 6-week low, U.S. equity futures also retreating. Now, Bill Gross's successor, Nick Maroutsos, quits his job aged 44 to spend time with his children. The man who took over from the Bond King says that the pandemic has caused everybody to reevaluate their goals in life. Are people in elite jobs realizing that life is too short? Well, joining us now is Bloomberg opinion columnist Elisa Martinuzzi. Elisa, in a recent piece, you really wrote about the financial industry's work culture, and you said that it could benefit greatly by giving staff more flexibility, cleaning up its image of a dangerously rigid work culture. You can read that on Up and Go. Elisa, so exactly, first of all, how unusual is this to happen? And do you think there is something in the water about a pandemic and people actually reevaluating their life goals?
Absolutely. I think, the motto, you only live once, is really being embraced right across the workforce. And we're talking here about very much office workers, the fortunate among us who've, maintained our jobs through the pandemic. Many people have been able to save more than they would have been before by, saving on their commute, etc. And what the data points to is, potential inflection points. So, for example, U.S. government data shows that millions of over 55-year-olds want to retire earlier. But it's not just the more seasoned among office workers that want to think about, living their lives differently. A recent Microsoft survey showed that, employees are struggling, and a quarter of them are thinking about leaving their employer. So you really are seeing sort of right across the office workforce a rethink as to how people, as Moses says, want to live their life and what their goals are.
Yeah, Elisa, I mean, it seems to, when we look at chief executives, they're trying to throw money at the problem. So is it a culture of a company that gets people to stay, especially in finance?
I think you're right. A lot of the measures that we've seen being announced, particularly in the financial world, to tackle overwork and it has been, more money, bonuses. But you are seeing sort of, a shift in mentality, a shift in culture also in the way of, for example, Citigroup introducing sabbaticals for staff after a number of years that they've worked there. And perhaps more flexibility. Yeah.
Thank you so much. Maybe more flexibility is the way to go. Elisa Martinuzzi there from Bloomberg Opinion.
Readings on inflation are likely to rise somewhat further before moderating.
You'll be looking at significantly higher inflation than the Fed expects.
There will be more bumps in the road.
This is Bloomberg Surveillance, early edition with Francine Lacqua, Matt Miller, and Kailey Leinz.
Well, good morning from London and New York on this Thursday, May 13th. Our top stories today. Turning on the taps, fuel starts to flow again through the largest gasoline pipeline in the U.S. Southeastern states, hurt the most by the shutdown, will start to get relief this weekend. Elon Musk's crypto chaos. Well, Tesla's chief executive makes a surprising U-turn on using Bitcoin to buy electric cars, and the digital currency is falling. And looking past the pandemic, we talked to the chief executive of Africa's largest bank about what comes next. Now, of course, I'm Francine Lacqua here in London. Kailey Leinz is in New York. Matt Miller is off today. Kailey, Kailey, underpinning everything, and we did see a major sell-off here in Europe in the last 50 minutes, is inflation. I think there were two major concerns. First, why are forecasters, is it so hard to actually see an economy that's improving, given they were wrong on jobs last week, given inflation is now wrong? And of course, does one inflation print change the way that the Fed looks at tightening?
Yeah, the big question, Francine, is what exactly is transitory? And even if it is transitory, for how long does this spike in prices last? Those are the questions the market is really grappling with. And as it does so, it is decisively risk off. Of course, we had steep losses in the U.S. yesterday, and we're seeing a bit of catching up to that in other global equity markets. In the Asian session, stocks lower across the board. You actually had the MSCI Asia Pacific Index falling about 10% from its peak, so in correction territory. And stocks in Taiwan falling for a third day, now down 11% from its peak just last month. So that stock index is in a technical correction as well. In other asset classes, you also saw Asia dollar bonds coming under a little bit of pressure, while the Japanese yen is getting a bit of a safe haven bid, stronger against the dollar, sitting at 109.58. As for what the picture looks like in Europe, as you alluded to, Francine, the older the session grows, the uglier it gets. We're looking at losses of at least 1%, approaching 2% across all the major equity benchmarks. At the moment, the Stoxx 600 is lower by 1.4%. The FTSE 100 in the UK now off by more than 2 full percentage points. And in the bond market, the 10-year German bond yield is at its highest since May of 2019, right now at just negative 10 basis points. In the foreign exchange market, the euro is fractionally weaker against the dollar, sitting at 120.65. As for what the picture looks like here in the U.S., we saw losses of 2% or more across the benchmarks yesterday, 2.6% for the NASDAQ 100 in the Wednesday session after that better than expected or an upside surprise on CPI data. And once again, NASDAQ 100 futures lower by 0.3%. In the Treasury market, yields climbed 7 basis points on the back of the data yesterday. We're unchanged at that level, 1.69% on the 10-year. And of course, Francine, the other story we've been following all week is the shutdown of the Colonial Pipeline, but it has resumed operations as of 5 p.m. last night, so we should see some relief on those shortages starting this weekend. That is taking both crude and gasoline futures lower. WTI crude down nearly 2% to 64.79 a barrel. And then, of course, we also have to pay attention to Bitcoin. Elon Musk doing the U-turn of all U-turns. No longer will Tesla be accepting Bitcoin as a payment because of environmental concerns, and that is taking the cryptocurrency lower by the better part of 8%, or just around $50,000, Francine.
Kailey, this is what we're looking, of course, at the rest of the day. 8:30 a.m. in New York. New York time, we'll get more economic data with U.S. PPI. We'll also get the weekly initial jobless claims. 3 Latin American central banks post interest rate decisions today, beginning with Mexico at 2 p.m. And we'll also get earnings from Alibaba, Walt Disney, and Coinbase. Again, I guess underpinning all of it, I mean, the PPI is a big one, Kailey, and this is the first thing that you said also when you came in, and you were 100% right. The question is, why are forecasters, why is it so difficult for forecasters to exactly see what kind of reopening we get? And again, the word, and you say transitory, but transitory basically means, are we going to shop a hell of a lot and then stop shopping, or is this a trend that's set to continue?
Right, and it's so hard to know, right? It was a recession unlike any other, and the recovery also clearly is unlike any other, and it is proving very difficult for economists to forecast what exactly we are going to see as things reopen. Now, of course, feeding into the inflation narrative has been the higher prices Americans have had to pay at the pump. The biggest gasoline pipeline, though, in the U.S. is returning to service almost a week after a cyber attack that saw gas stations run dry. Colonial Pipeline Company says it began to resume shipments yesterday at around 5 p.m. Eastern time. Let's get more from Bloomberg cybersecurity reporter Jamie Tarabay. So, Jamie, operations resuming. When is the actual relief going to come?
Well, it really depends on, what Colonial is saying. From our point of view in the cyber security aspect that we've been discussing all of this time, it was only a couple of days ago that the CEO of Colonial said that fuel shipments will not resume until all the ransomware has been removed from the system. So we're really curious about what they've done to mitigate that. We know that they have worked with private cybersecurity firms and with government agencies to figure that out. And we're still waiting to see what they've actually got to say. We know that the hackers stole over nearly 100 gigabytes of data from the IT network. And Colonial has said that the operational system, which handles the pipelines and the flows, have not been compromised. So whether they've been able to separate the two, whether they've been able to make one of them work or the other, we just really need to sort of hear from them. We're not the only ones waiting to hear. In testimony to a Senate committee on Tuesday, Biden administration officials said that they're still waiting on technical information from Colonial to be able to warn other potential victims. And that's the other side of this regarding a ransom, etc. We need to hear what the hackers have to say if these shipments go ahead. Whether that information that the hackers are holding at ransom will be released, or whether Colonial has been able to de-encrypt the system by itself. We know that also today that President Biden signed the cybersecurity order, and it's really meant to make every sort of government agency and corporation that works with governments to boost their cybersecurity aspects and their networks and show a little more accountability and increase their communication.
Jamie, thank you so much. Of course, that's a huge angle because we know that so many companies are now looking at cybersecurity because of this. And then, of course, we understand that we'll have a bit more normalcy when it comes to the oil markets, hopefully by this weekend. Now, Bitcoin is the other big story, tumbling after the Tesla founder Elon Musk announced that the car manufacturer will no longer accept payments in the cryptocurrency. Now, Musk cited environmental concerns, saying Bitcoin mining and transactions are too carbon intensive. Joining us now is Bloomberg's Danny Berger. Danny, I mean, I love this story because we all knew that it wasn't a green technology, but suddenly, Elon Musk says, oh, it's not green, and it tumbles.
Yeah, and presumably, if you and I know that, then Elon Musk would have known it too when he first adopted Bitcoin, which really was not that long ago. First of all, I do just want to take a pause and give our producer Max Ramsey props for putting together this full screen with a very zen Elon Musk on it. I just love this as a backdrop for this story. But look, as Nick Carter of Castle Island Ventures put it, surely he would have done his due diligence. So this sudden reversal and the timing of it is odd. We don't really know why he had this. Was it, ESG pressure from shareholders? Was it perhaps regulatory concerns? Does he want to go out and start to develop his own cryptocurrency that's more environmentally friendly? He kind of hinted towards looking for more ESG friendly options for cryptocurrencies. Either way, certainly giving Bitcoin investors a fright. We're going back now down towards $50,000 per coin. And this was one of the major catalysts, at least that we could easily see over the past year, that fueled Bitcoin higher. So now that's being taken away. And I perused some of the Reddit boards, and people are really not happy about this. So what does this mean from here? It could mean that some of the other cryptocurrencies continue to gain against Bitcoin. We've already seen Ethereum do that. So that sort of relative value crypto trade could be the one that people start to put on with this recent move from Tesla, Kailey.
All right, Bloomberg's Danny Berger, thank you. I would note Dogecoin as well is down about 17% over the last 24 hours. Speaking of things that are down, European equities and U.S. futures again weaker today amid renewed inflation concerns. We had that much higher than expected U.S. CPI reading yesterday, and now attention turns to PPI coming up in a few hours' time. Let's get some perspective from Bloomberg opinion columnist Marcus Ashworth. Marcus, if we get an upside surprise on PPI as well, how ugly could it get?
Well, I think this is, people are blaming inflation for what is actually a positioning change because people are just understandably worried about what's going on with this tech sell-off, and people are thinking, oh my word, I'm long lots of bonds at very low yields. Should I be reallocating and sorting my perspective and my strategy out? But, obviously PPI is like a month forward of CPI, as in it will feed through. So the number we see today will show us, or give us a clue what will be the CPI for next month. So if we see a very strong month-on-month gain, above the sort of 0.3, 0.4 area people expect, then that obviously would mean that we're expecting a bigger CPI number next month. But if you look what the Fed's saying, they can see through this. And, what do you expect after a huge collapse and then a big rebuild with massive stimulus? You're going to get choke points. And if you look through the CPI, it's all in the things like used cars, airplane tickets, car rentals, all that sort of stuff which is transitory. And we're seeing it in our consumer and retail stuff as well. So I think the markets are surprised about something they knew was going to happen. So I think probably we'll rattle around, a bit more volatility, shifting of positions, and we'll after the end of this quarter, going into the summer and out, we'll probably calm down a bit.
All right, well, 2 hours and 20 minutes to go until we get that read, so we'll all wait and see. Bloomberg opinion columnist Marcus Ashworth, thank you so much. Now, I do want to take a look at a few more micro stories, the stocks moving in pre-market trading here in the U.S., one of them being cancer drug developer Cirrus. It is down more than 11% in early hours. The company reported severe side effects in one of its studies, and that's weighing on sentiment. Wish, the discount online retailer, also sinking about 10% after giving a revenue forecast for the current quarter that missed expectations, really just reinforces concerns about growth. That stock is down by more than half since its IPO in December. On the upside, though, Silvergate Capital, a prominent player in the crypto industry, rising 11% after the announcement that the DM Association, Facebook's crypto project Reboot, will be in an agreement with the company to issue the coin. And finally, Sonos, the speakers maker, rallying the better part of 11%, topping all estimates on multiple metrics, also lifted its annual revenue forecast. Apparently, a lot of people out there buying sound systems, Francine.
Sound systems, there you go. That's, I don't know whether that's how many or how often you buy sound systems, actually, if that's inflationary or it's transitory. Coming up, we talk about sound systems and, of course, inflation with Marija Veitmane, State Street Bank Senior Multi-Asset Strategist. And then a little bit later, a conversation with the Chief Executive of Africa's largest lender, Sim Tshabalala of Standard Bank. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Kailey Leinz in New York, Matt Miller off today. Now, inflation concerns are dominating market sentiment. One investor, says he's excited about higher inflation. Here's what Davide Serra, the chief executive of Algebris, said earlier on Bloomberg.
We were sailed up for a reflationary trade, but I think it's going to happen in the next 2-3 years. And most market participants are going to say no for the simple reason, because they've been benefiting for 40 years out of this central bank action. So now, I'm a Catholic person, and we used to believe, God is the response to anything. Now there are market participants that think the central banks can do anything. Well, that's not true.
Well, joining us now is Marija Veitmane, Senior Multi-Asset Strategist at State Street. Marija, first of all, I know it's difficult to forecast economic data, but can it really be this difficult? I mean, if you look at the jobs there, it was completely off, and yesterday inflation was also completely off.
Yeah, no, I think it's an interesting point, is that I don't think it's been a very, very long time since we had such outsized surprises in economic data. And I suspect that's to do with the nature of recovery and probably a little bit with the nature of statistical offices, how is data collected, how is data picked up. I mean, we spent all of last year talking about K-shaped recovery. So there are some sectors and parts of the economy that really benefited, others really struggled. Now we're having this kind of resetting and kind of rebalancing. So different parts of economy performing really, really differently, and different bits of economic data pick up on that. I suspect that's really what's making it very difficult for forecasters to really get a very good grip on the numbers.
So Marija, the real question is really, does one inflation print, which was pretty staggering, does it upend what the Fed will do? Do you think it will, and what does it mean for where you want to be invested in the markets?
I mean, we've been on a very kind of positive market trend. We expected equities and risk assets to perform strongly on this reopening trade, and Fed staying still. And Fed told us if inflation is transitory, they'll look through it. Yesterday, we had a really, really kind of outside surprise, but I don't think it answers the question of whether inflation is transitory or not. We had a bunch of Fed speakers coming out yesterday saying that they think it's transitory, looking at the components that really increased the kind of post-reopening kind of catch-up component, so they don't see it as permanent. We kind of happy to give it benefit of a doubt, and I suspect we need to wait another couple of months before we can actually understand whether the inflation is transitory or permanent. So I think despite this really huge surprise yesterday, we still don't know.
Even if
we're sticking with our kind of slightly positive tone of them.
Well, Marija, even if it proves transitory or while we figure out if indeed it is transitory, do you still need to hedge against it? And how do you do that?
Yeah, no, that's a fair point. And actually, I mean, to some degree, that what we saw in kind of February, March, when we had this very, very substantial kind of repricing of growth expectations. So we had bond yield going up, we had real rates going higher. What I thought was really interesting back then is that the higher interest rates are kind of a result of slightly, I mean, higher inflation expectations, didn't really upset overall equity markets. So stocks continue to go higher. And I suspect the reason for that was higher interest rate, not necessarily kind of trickle through to real economy. Financial conditions stayed still very, very accommodative. Companies and consumers still have very strong kind of balance sheets. They managed to raise a lot of debt last year at a very, very cheap rate. They still awash with cash. So we didn't see that trickling to kind of real economy. So stock market continued to go higher and earnings been super strong, and that's testament of that. What happened was a rotation from growth to value. Oh, sorry, from growth to value, and that's really kind of the crux of equity question. But in terms of overall direction of equity market, I mean, we continue to make new all-time highs.
So, Marija, though, picking up on equities and tying in the bond market here, the equity risk premium is shrinking. When you look at the spread between the forward earnings yield on the S&P 500 and the 10-year Treasury, we're only looking at around 280 basis points. When does that start to bite, especially if we see yields going up from here?
Yeah, I think that's really, really the right point, is that when yields are going higher and how much higher and how much faster they're going. So for a long time, equity investors have been kind of conditioned to look through those kind of extended valuations because we expected interest rates to stay, interest rates were very, very low, and we expected them to stay very, very low. So I think really the kind of the connection with interest rates is absolutely key. And as we said, right now, we're still not much wiser, like where interest rates are going. The only thing I'll point out, it's probably quite important to look at real rates as opposed to nominal rates, as that's probably more important factor driving equity markets. And real rates, I mean, given the inflation numbers we've seen at like decade highs, that's kind of kept a little bit.
Marija, thank you so much. Marija Veitmane, their senior multi-asset strategist at State Street. Now, coming up, Colonial Pipeline restarts, but the crisis is not over. We'll discuss the challenges ahead with Dan Brouillette, former U.S. Energy Secretary. That's at 12 p.m. in New York, 5 p.m. in London, and this is Bloomberg. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua in London, Kailey Leinz in New York. Matt Miller off today. Maybe he couldn't handle Bitcoin, tumbling by so much. Now let's get straight to the Bloomberg First Word news. And southeastern states suffering the most from gasoline shortages will start to get relief this weekend. The nation's largest fuel pipeline has resumed operations after that cyber attack. Well, fuel started flowing yesterday afternoon, but a fleet of tanker trucks is needed to transport it from gasoline terminals to retail stations. And President Biden spoke to Israel's Prime Minister Benjamin Netanyahu about the most violent clashes between Israel and the Palestinians in years. While the president said Israel has a right to defend itself against the rocket attacks, the militant group Hamas has been firing the rockets from the Gaza Strip. Israel has responded with air raids. The CDC has opened up a new phase in the U.S. immunization effort, while an agency advisory committee says that children 12 to 15 can safely take the coronavirus vaccine made by Pfizer and BioNTech, while the FDA cleared the vaccine's use on adolescents earlier this week. And he succeeded the legendary bond investor Bill Gross, and now Nick Maroutsos plans to just walk away from the job at age 44. Maroutsos will leave the position as head of global bonds at Janus Henderson in October. One thing's on the schedule, that's taking cross-country trips with his young children while, as he put it, they still like me. Maroutsos tells Bloomberg that in a year, they'll probably resurface in some capacity. I love that, Kailey. It's like, you're retiring in the finance world, but actually, usually you end up somewhere else.
Yeah, well, this one's interesting to me, Francine. I've had the pleasure of talking to Nick Maruzzo several times on Bloomberg Television. He truly is one of the best, but it speaks to this idea as finance firms specifically are really mandating people come back into the office at least part of the time when other companies aren't. Anecdotally, I have a friend who lived in a van for 4 months during the pandemic because she could work from her van, and her company would potentially let her do that forever. And if you have a job that requires you coming into the office and you can't do that, maybe you think, well, maybe I just won't work here anymore.
Yeah, I mean, that could be one of the reasons. I imagine if you're in charge, you also set the rules. So it's something that, it's just a life decision, I guess. After the pandemic, you say, actually, what kind of life do I want? And what kind of relationship, in certain cases, do you also want with your kids? Now, coming up, the chief executive of Standard Bank, Africa's largest lender, on the post-pandemic future. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Kailey Leinz in New York, Matt Miller off today. Now, it's all about inflation. I know we have a lot of stories, Kailey, that you and I both love talking about, which is, of course, the pipeline, trying to figure out what happens there, Bitcoin, but really underpinning these markets. Inflation, and certainly in Europe, they were significantly lower, I would say, in the last hour and 10 minutes.
Yeah, inflation fears really rattling markets. Of course, that started yesterday with the upside surprise on CPI. But coming up in about 3 hours from now, we get the PPI print. And so markets are really just awaiting that data, Francine. As you said, the European session really at this point is quite ugly. We are off session lows, but still we're down about 1.3% on the stock 600. Here in the U.S., futures again off the lows, but of course we're coming off losses of more than 2% across all the major benchmarks. The NASDAQ 100 fell 2.6% in the Wednesday session. Today, futures down about 19 points. The 10-year Treasury yield right now unchanged from yesterday's levels after a big move upward we saw on the back of that CPI data. We're just around 1.7%. And then, of course, there is one asset I want to check on that you can't use to buy a Tesla. Elon Musk has changed his mind, no longer accepting Bitcoin as a payment for those electric cars. He's concerned about the environmental impact of mining, that taking the crypto coin down 8%. We are now sub $50,000. And of course, with losses in Bitcoin, you can expect that a lot of crypto-tied stocks are under some pressure in pre-market trading, and that is indeed true. We're looking at losses of now about 13% in early hours for the likes of Marathon Digital and Riot Blockchain. Coinbase, of course, the cryptocurrency exchange, it's lower by about 4%. And even Square, Jack Dorsey's payments company that is indeed tied to crypto, is lower by about 1.3% before the bell, Francine.
Kailey, that's the one thing that, of course, we need to keep an eye on. Now turning on to Africa's largest lender. So let's talk banking. Standard Bank is laying the groundwork for the post-pandemic era. The bank is making plans to bulk up its businesses and accelerate its digital transformation. Now, with operations across 20 African countries, Standard Bank has been shielding from some of the economic pain faced in its home market of South Africa. Well, joining us now from Johannesburg is Sim Tshabalala. He's the chief executive of Standard Bank. So thank you so much for joining us this morning. How worried are you about waves of COVID with new variants that could actually impact your growth forecasts?
Good morning. Yeah, of course. South African GDP growth is built to be roughly 3.3%. That's according to the National Treasury. Our own economists expect it to be roughly 4.6%, actually, of a decline of 7% last year. That decline of 7%, as you correctly allude to, was exclusively as a consequence of COVID and the response by the South African authorities to the pandemic. A 1-in-100-year event, a hard lockdown, which had a material negative impact on GDP growth. You correctly allude also to the fact that we are facing a third wave. We don't think that we will repeat the mistakes that were made last year. I think we've all learned by doing. The protocols that are in place, the health system processes, social distancing, the discipline of South Africans, and then the increased availability of vaccines, we believe will give rise to a more muted effect, much different to the first wave of last year.
So if there's a third wave, if there is a third wave, and it's, of course, we always think about the loss of life and all of the horrible things that people have to go through because of that. But what does it actually mean for your revenue? So what kind of, where does it hurt the most for Standard Bank?
I think, again, depending on the nature of the lockdown and the response to the third wave, if it's as hard as the first wave of last year, what you then see is a slowdown in activity in the hospitality industry, a slowdown in activity by aircraft and airlines, but then an increase in activity by people involved in electronic channels. It definitely puts a pressure on our top line if that happens. And then it also increases our bad debts, particularly in the segment that is focused on small to medium enterprises who suffer the most during hard lockdowns. But I don't believe that we'll have as hard a lockdown as we had in the early part of last year. I think to the extent that there is a third wave, the country has learned to cope with the social distancing that arises from that. So we don't think it would be as dramatic as the first lockdown last year.
What does that mean, though, for your capital deployment and potential expansion? Are you going to have to put that off for longer?
No, actually, a lot of the developments we saw leading into the pandemic, digitization, the continued development of cities in South Africa, but in the rest of the continent, the insertion of African countries inserting themselves into global value chains, like, for example, Mauritius and Ethiopia, those trends are going to continue. And we as Standard Bank will be positioning ourselves to support our clients who are either responding defensively or responding aggressively to the competitive dynamic that arises from these challenges. And so we will continue to judiciously deploy our capital as we see growth in those growth pockets.
Switching over from kind of the pandemic impact into more politics, the South African President Cyril Ramaphosa obviously is trying to kind of get rid of corruption. What do you think he's made adequate progress, and what other changes would you like to see from a business perspective?
You know, like John Adams said of the United States in the 1700s, our country is a country of laws, not men. And to be frank with you, this crisis that South Africa has been through has reestablished the principle that we have got a great constitution, we've got great institutions, and they are asserting themselves. The law enforcement agencies are taking action. The National Prosecuting Authority is executing against some disciplined actions. The Zondo Commission is taking action. And so the law is taking its course in South Africa, and it's actually fantastic from a business perspective because you can rely on the rule of law as a consequence. We do think that the structural reforms that are necessary to be taken are happening, but they're happening far too slowly. And we all take the opportunity to encourage the leadership of South Africa, firstly to buttress law and order, buttress institutions, and then give effect to these structural reforms. Improvement of the situation at the ESCOM, release the spectrum, and insert South Africa into, as I said earlier on, the global value chains which have now been dislocated. I'm turning it around to say actually South Africa faces a fantastic opportunity as a consequence of the aftermath of COVID.
Mr. Tshabalala, talk to us a little bit about inflation concerns. So this is underpinning all the markets. Of course, if the Fed does something, it directly impacts not only your currency, but I imagine your bank. Are we mispricing global inflation? And how much time do you spend thinking about a possible market event like that?
We spend a great deal of time because, we're involved in the international competition for capital. And where yields are higher in the US, it has a negative impact, obviously, on the competitiveness of our countries. And then the negative impact on equities in the US also has an impact on Africa. But at the end of the day, what we need to stick to are the forces that we've got control over and those that we understand. And CPI in South Africa, Consumer Price Index, is averaging around 3.9% this year, and we think that the rand will average around 14.50 to the US dollar, and our planning is roughly around those trends. we take a long-term view and we position our bank accordingly.
Thank you so much, Sim Tshabalala. They're the chief executive of Standard Bank. Now, coming up, the president and Republican leaders see a path to an infrastructure deal with one major obstacle remaining. So we'll have more on that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Michelle Seitz, Russell Investments Chairman and CEO. This is Bloomberg.
I think there's an opportunity that we could work together on infrastructure. Now, let me preface that. We're not interested, as long as it's not anything about tax increases, and it dealing with infrastructure. That we start with the concept, what is the definition? And that we're able to make reforms so you can actually build the roads not decades away.
Representative Kevin McCarthy speaking yesterday after meeting with President Biden. Marty Schenker, Bloomberg editor-at-large, joining us now. Marty, clearly there is a wide gap to bridge between the Biden administration and Republicans in Congress. Did that gap shrink a bit yesterday?
Well, it probably didn't shrink necessarily, but they did get some fairly decent vibes out of the Republican leadership that there might be a deal to do on infrastructure, but much smaller than Joe Biden wants.
And what about taxes? And this isn't just a Republican issue, this is also a Democratic issue. And yesterday we saw the likes of Senator Joe Manchin putting forward some proposals regarding taxes, not necessarily the higher corporate tax rate, but some of the other issues that President Biden has raised in tax reform. There seems to be support for. So how far will it go?
Yeah, it was very interesting to see Joe Manchin back repealing of the carried interest tax loophole that many wealthy investors use, especially on Wall Street, to raise revenue. Joe Manchin, of course, has said he is not in favor of the 38% rate on corporate taxes, but if they're going to do infrastructure, they're going to have to find a way to fund it, and the Republicans say it's not going to be with higher taxes.
Marty, House Republicans also removed Representative Liz Cheney from her leadership post. She was a vocal critic of what happened with President Trump and certainly the insurrection on Capitol Hill. What does it mean for the GOP? Is there less, can you dissent actually and still be a leader in the GOP today?
Well, she says she's going to continue to speak out, and she's going to work as hard as she can to make sure that Donald Trump is not the nominee in 3 years' time. But, the internal split between the more moderate, traditional, conservative Republicans and the Trump wing of the party is in stark contrast. And how they're going to come together in the midterm elections and take back the House and the Senate is going to be a key issue over the next 2 years.
But so, Marty, it's actually pretty amazing how much, control or extraordinary amount of power Donald Trump is still having on the GOP. Do they think that actually in 2022 they can't win without Donald Trump's support?
Well, that's the prevailing wisdom. And Bloomberg News this morning has a story that says, Trump's power over Republicans in the primary season is going to be a critical issue and may not actually help these candidates. It might help them get the nominations in various races, but it may actually hurt them in the general election. So it really is up in the air what's going to happen over the next 2 years.
Well, speaking of what we saw with the Trump administration and contrasting it with the Biden administration, when it comes to the issue of Israel and the violence we have seen in the Gaza Strip over recent days, is President Biden going to be forced to take a different tact when it comes to relations there?
Well, Anthony Blinken, the Secretary of State, has sent an envoy to Israel to try and de-escalate. But it's a very tricky issue. There are a lot of progressives in his party who feel that the Palestinian cause has not been properly addressed. Of course, Donald Trump took a strong pro-Israel stance, so he has a difficult balancing act, not only from a foreign policy standpoint, but from a political standpoint in his own party.
Marty, were they almost blindsided by what's happened? Have they focused on the other parts of the Middle East without thinking that this would flare up?
I think that not only was the administration blindsided, I think a lot of people outside in just the general population this seemed to come out of nowhere. But these tensions between the Palestinians, Hamas, and Israel have been brewing for decades. And so it really shouldn't have been a surprise, but the level of intensity is.
Marty, thank you so much. Marty Schenker there, of course, our editor-at-large with everything to do with Washington. Coming up, the king of SPACs wants to make you rich. We'll discuss this week's Business Week cover story next. It's a good one. This is Bloomberg. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua in London, Kailey Leinz in New York, Matt Miller off today. Now, Tom Keene is here, co-anchor of Bloomberg Surveillance, and he joins us now to talk about what we're looking at the show, jealously watching maybe, Nick Martsoussos, who just walked away from his big job at Janus Henderson, Tom, at 44 years old.
Yeah, I don't think walked away is the right thing, but this is something really to watch, Francine. I think this is, and everything in life, whether it's somebody 20 years old who said, look, this last 14 months was harsh, all up to fancy people like Nick. The answer is everybody's recalibrating and rethinking what they're doing, their priorities out of the pandemic. And for every single corporation worldwide, this is going to be a challenge.
Right, and I guess the question is, how do you address it? Is it culture? We know a lot of the law firms, for example, are throwing bonuses at juniors to make sure that they still want to stay. But, I guess the question is, do you want to live like we lived pre-pandemic? I don't know if this is a story here, given that he was actually in charge and probably could have changed some of the flexibility, right?
Everybody's going to talk their book here. I mean, the idea here is you make equities so you have the luxury of retiring like Nick Martsoussos. Let's make clear, he's economics out of San Diego, which is the ACE statistics program in America, and then with his MBA and his work with Mr. Gross at Janus. But the bottom line here is guys like Nick Martsoussos can do this. They can move on, without the tax burdens that so many people face. There's a lot of other people that aren't in Nick's position, but they're still recalibrating and making those choices right now.
Tom, inflation, the markets, certainly in Europe, more than took notice, are now kind of really worried about what's coming. Why is it so difficult to forecast what kind of recovery the U.S. will have?
Well, the forecast of the recovery is separate. I would look at it as a partition of what we're seeing in finance and in price change, like inflation, and also the calibration of real GDP. Francine, what I would do is wait for tomorrow's retail sales numbers, which will allow every house to recalibrate and tweak their GDP estimates. You're going to see over the weekend and into next week a whole set of recalibrations of this boom economy. But with any boom economy comes inflation.
Absolutely. It just depends on whether it's transitory or not. Tom, thank you so much. I'm looking forward to the program.
Thank you. I can start.
Transitory.
Transitory.
Yeah, like your hits. Tom Keene, transitory, co-anchor of Bloomberg Surveillance, joining us. Now, Chamath Palihapitiya is the subject of the latest issue of Business Week, and the tech billionaire has a can't-miss investment for you that will definitely absolutely pay off for him. Bloomberg's Zeke Fox, who wrote the story, joins us to explain. Zeke, first of all, congratulations. I know it was months in the works. It's a fantastic story. It's the cover story of Bloomberg Business Week. This is about SPAC. So this is, a famous investor, unusual investor who's basically saying, trust me, I will make myself money and bring you along for the ride.
Yeah, so Chamath Palihapitiya is a billionaire. He made his fortune first as an executive at Facebook and then as a venture capitalist. And now he's sort of the face of the boom in SPACs, which are these blank check companies where investors are handing over their money to sponsors like him who say, hey, I'm raising this company, it's going to be publicly traded, and then I'm going to go out and buy a private company and it's going to be a great investment for you. Chamath will often say that his are going to 10x in 10 years. There's been a huge explosion in these SPACs, and they've raised $600 billion in the last couple of years, almost displacing the traditional IPO.
Yeah, and we've spoken to a lot of, the number of former famous chief executives that are starting PACs is quite incredible. We spoke to, JP Morgan as well about this. The question is, are you famous enough and savvy enough to find the targets, or will you miss the targets for the SPAC?
Yes, and Chamath, he's the one who proved this concept. His first big deal, Virgin Galactic, when he made that merger in 2019 and saw the stock almost quadruple in a few months, that proved that these SPACs really worked, and I think spawned a lot of copycats.
But they're not working anymore, right, Zeke? How much faith does he have in the ability for this boom to continue?
Well, that's the question I looked into, because the way the SPAC is set up is that the sponsor, when they raise the company, is given 20% of it generally as a kind of fee. So they're set up in a way that they're going to win, they're going to make a lot of money, pretty much regardless of what happens to the company. Now, even with SPACs lately, the stocks have been down pretty hard. Chamath's holdings are still looking good because of the way these deals are structured.
What's he in it for, Zeke? Is it about the attention? He says his motives are, altruistic. He wants to use his money to solve the world's problems.
That's what really got my attention about him. When he came out there pitching these SPACs, the pitch was sort of that, here's how I got rich. I'm so good at picking companies. It's made me a billionaire. And you know what? Almost out of the goodness of my heart, I'm going to let you, the individual investor, participate in my genius stock deals. And whenever I hear someone say something like that, I'm a little suspicious, because if he is so good at making these deals, what does he need the individual investor for?
All right, that's all the hype man. I like it. It's a really good story, Zeke. So thank you so much for coming on to talk about it. And I urge everyone to read it. It's our big take today on Business Week. Zeke Fox there joining us with the latest issue on our magazine. Now, look at what else we're watching. It's all about data, Kailey. We woke up. Yep. I was skeptical. It's all about the data.
My life is just waiting for PPI at this point in time, Francine. We have about 2.5 hours to go until the data crosses. And my question is, are we going to get a big surprise? Because as we've been talking about all hour, we've seen some big surprises on the data. Downside surprise on non-farm payrolls last week, upside surprise on CPI yesterday. It is incredibly hard to forecast. So it'll be interesting to see how the number actually comes through, Francine.
I'm just looking at the pipeline as well, Kailey. So this is, of course, one of the big stories of the week. We understand that it's now reopened, but it actually will take a couple of days. And we had to move to address some of the fuel shortages spurred by the cyber attack. So I'll look at that. Unclear how long it will take for the network to return 100% to normal. Coming up, all about data, economics, and inflation. This is Bloomberg.